Welcome to the Charlie Paparelli Show. I am Charlie Paparelli. Today we're going to be talking about how moving from entrepreneur to philanthropist. To be sure not to miss an episode, please subscribe at paparelli.com. All you have to do is submit your email, and you will receive notice as to when these interviews come up. And as a special bonus, you'll also receive my Tuesday morning blog just specifically for entrepreneurs. This show is all about entrepreneurs helping entrepreneurs. And to that end, I interview leaders who not only build successful businesses, but also have productive and successful lives. Today, my guest is Greg Thompson. Greg is the founder of Tomco, a specialty commercial insurance brokerage. He built the business to a sufficient size to attract private equity investment. And then he eventually sold, they eventually sold to a company called Markel. Greg then accepted an executive position with Markel and worked with them for 6 years in helping them build their business. So Greg has some great experience, not only as an entrepreneur, an independent operator, but also working in a corporation. Greg is now a sought-after advisor in his space, and he sits on for-profit and nonprofit boards, which we'll be getting into. So welcome, Greg. Thanks for taking your time and joining me and helping me understand you a little bit better, and also your my audience.
Well, thanks, Charlie. I'm happy to be here today.
Well, it's going to be great. Like I said, the reason that we originally got together was because I was real interested in how people move, how entrepreneurs really move to philanthropy. And I'm seeing that a lot of entrepreneurs really don't make that move. You know, it's one thing to know how to make money, and spending our whole time, all of our mind share and everything is how to make money. It's a whole nother thing to say, how do I give away money? And the most famous of these, I think, is Bill Gates, you know, where he said, I quit Microsoft and I'm with the Gates Foundation, and that's what I do. You know, so his mind share has been freed up. But it's been something when I talk to entrepreneurs, they're not very much into philanthropy, yet they have the resources to do it. So hopefully we'll talk about that a little bit today, and we'll touch also on your business and also the board seats that you're all a part of. Okay.
Absolutely.
Good. So tell me, Greg, you know, maybe just kind of get us started is just what you're up to these days, you know?
Well, we don't have 5 hours today, but
Are you up to that many things?
It's a lot of different things. Well, I'm on 7 boards, and that doesn't count some of the unofficial jobs that I do for a couple of nonprofits and some independent consulting. But anyway, you know, one of the things that I'm doing is I'm really enjoying doing some independent consulting with entrepreneurs who are in the exact same business that I was in, which I was an independent contractor for underwriting for insurance companies. Basically, They would sub out business to me. And so I help those guys. I'm on the board of 3 companies like that who do that. They're very similar to the company that I built. I'm on the board of 2 nonprofits that are doing some amazing work around the world, and I'm on the board of both of a country club and of an insurance trade association.
Country club and insurance trade. Okay.
So I'm all over the map.
All right. Well, what's interesting to me is and this has happened in my life too, when you move from sort of independent operator that you were, how did these board positions sort of come your way? You know, that's something that you hear a lot of CPAs that I know when they retire from public accounting. Of course, they're highly sought after because they all want people to come in and head up the audit committee, you know, kind of a deal, and the compensation committee, and those CPAs do a good job with that. But what about you? How did you make this transition from your business into having people be attracted to you as a board member versus just an advisor?
Well, on the private company side, the business side.
That's what I'm talking about there first. Okay.
A lot of it was all word of mouth. I have been very active in the trade association for my business, and gave a number of workshops along the way, and just been
Mhm.
very active with the board of the trade association. And so I knew a lot of people. A lot of people had heard of me, and so when they heard that I retired, I started getting calls about being on boards of some of these private companies that were seeking to be the kind of company that I built.
Well, these companies, you say you got three that are company. You're on three boards that are
Yes.
companies, kind of like the company you built. Okay.
Yes.
Are they big companies, small companies? I mean,
they're relatively small companies, but they're not startups. Okay. So they're all, I would say, in terms of revenue, somewhere around the 10 to 15 million revenue type business. They might have anywhere from as small as 20 employees to as many as 50. So they're not huge companies, but they're not startups either.
do they have outside investors?
Yes. And in a couple of cases, I'm one of the outside investors. Well, in one of the three, I'm an outside investor. I chose to invest some of my money after I got on the board. And then, in one case, a guy that we decided, instead of paying me consulting fees, he just gave me some ownership in the company.
Got it. So are these, when you say you're on the board, who else is on the board? And when you get into these smaller companies, in a lot of cases, maybe with outside investors, you're going to have one of the investors certainly on the board.
Right.
But a lot of times what these people do is they just populate the board with all of their founders and executives, Are these really independent boards?
They are independent boards because these are companies that want to build something amazing. Okay, they want to build something that will be hugely successful. So, I tend to end up on boards of companies that have a vision to be something much bigger and much stronger than they're starting out as. And so, they will get outsiders like me on the board. I'm not the only outsider on any of these boards. For example, American Rental Association, they don't have their own captive insurance arm. And so we have a number of other insurance people on that board. And then we have people from the rental business on that board. And so we've got a number of outside people. There's some management on the board, but most of it are from those two categories.
So what was attractive? Why were you attractive to them? There must be people with different backgrounds on the board, different than your background. Okay.
Yes.
So why were you attractive to them? I know you built a company like that, but
Right.
it's.
Well, what I love about the business that I built, it was so specialized by industry. And so you get to the point where you really understand a particular industry, and therefore you understand how to insure it, how to underwrite it, how to price it. And so to me, the American Rental Association is a great business to be part of because it's a huge business, the rental business. And it's mostly rental of equipment, of various, from small to huge equipment. And they created their own insurance arm, but they come from the rental business more so than the insurance business. And so I had an opportunity to help them learn from some of my business experiences being in the insurance aspect of specialization. And it's been great. And they would love for me to stay on for another 3 years, which I'm not, because I have, as you can tell, I'm very good at overcommitting myself, and I'm trying to learn from my mistakes.
So these aren't just sort of board positions. Obviously, what you just told me is interesting. So they actually almost brought you in. They're bringing you as a board member, but it's really this is a whole new piece of business for them that they're actually asking you to help them get into.
Well, I won't say it's quite new business. They've been in it for a while, but they basically it's an affiliate and part of the rental association, and so they're association people first, insurance second. They have been in the insurance business for a while, but they're still figuring it out. And so they wanted to bring in some insurance people like me that could help them take it to the next level.
Now, but their core business is rental of equipment?
Yeah, it's the American Rental Association, and then they created this captive insurance arm to provide insurance to the members of the American Rental Association.
So when we're talking about board membership here, this conversation was all about this insurance association. Is that what?
That's correct.
But I'm really was trying to address those three companies.
Well, the American Rental ARA Insurance is a separate standalone corporation that does what my company Tomco did. It just does it for the rental industry.
I got it. Okay.
So the other two is that is a company called Doxa that aggregates program administrators, company like my company, and they go out and acquire them as a conglomerate. And they're private equity backed, and I was advisor for the private equity firm. I helped them find this company to invest in. And we're now building it. We doubled the size of the company in the first year that the private equity fund became involved. And I'm on the board of the company, helping them make decisions about who to acquire and how to integrate them into the business. And so once again, I'm in the business that I built, but it's 7 or 8 businesses that we're aggregating, and we've got 2 or 3 more acquisitions we're looking at.
So did you actually meet these people through the work that you were doing with the private equity firm?
Well, actually, I met them when I was trying to acquire them in my company, because I did acquisitions with my company. I tried to acquire these guys when they did not have this aggregation company. They had another company, and I tried to acquire them, got to know them. And then subsequently, as an advisor to the private equity firm said, we want to make acquisitions in this industry. I found these guys, brought them to the private equity firm, and we did the deal. And then the private equity firm put me on the board of this aggregator. And so I continue to be involved.
So it's interesting that I also help and advise entrepreneurs. And I'm seeing more and more of this where they're trying to get into growth through acquisition. Okay.
Yes.
When you were doing that, were you trying to buy I'm talking about, this is prior to the private equity and investment that you took on in your company, Tomco. Prior to that, you're saying you tried to acquire companies on your own as 100% owner of your company. And
I was successful. We had three major acquisitions that we acquired, and really almost 40% of my company when I sold it was acquired business. So I already had experience doing that.
Well, what was your formula for doing that? Because, what I mean by that is, are you going after whole businesses, trying to acquire the whole business? Were they sizable businesses? Were you just trying to acquire premiums, for example, and clients? Okay. How did you finance these businesses, that you acquired? Yeah. How did all that work? What was your strategy for that?
Well,
it's hard for entrepreneurs to think about. They go like, oh, yeah, I could buy a business. They have no clue, right? They know how to sell clients, but they don't know how to buy a business.
Well,
so how do you go about that? How did you start that one?
Well, what happened was we built a really strong business on a standalone basis. And we had really good distribution network to sell our insurance products to. And we had really good infrastructure, IT in particular, that we built over time. Once we had built that mousetrap, we thought, look, we know how to do the back room. We know how to do the distribution. Let's find somebody with an expertise in an industry we're not in, and let's help make them better when we acquire them. And we did just that. We acquired 3 companies, and in all cases, we implemented our IT infrastructure, and we improved their distribution network on the sales side, and we were able to make them better companies. So it was 1 + 1 = 3.
I get that. So, but you make it all sound like, oh, of course, this is very easy. It was not a big deal. When you contacted the first company, like what the profile look like for the companies that you were interested in acquiring?
Well, the profile was very simple. I wanted to find companies that were truly experts in the industry they were insuring, that they had an expertise we did not have. But then
this is the vertical market expertise
exactly,
that they had.
Vertical market. But then on the other side, I wanted us to be able to bring something to the table. I wanted to add value. I didn't want to just acquire and just purely on the basis of acquisition for the sake of acquisition. I wanted to know that our infrastructure, distribution network could have an positive impact on the business. So they would bring us an expertise we didn't have. We would bring them some skill sets they didn't have, and together we would all be better in the process. And presenting this to a bank, and we did get some bank financing, it wasn't that hard to sell. I mean, because we were able to lay out to the bank why we were able to make these better businesses and improve the EBITDA, the profit on the business as a result.
Wow. So, but you have to deal with the other things when you're doing an acquisition like that is, oh yeah, we bring something to the table, you bring something to the table, and now we acquire you. And by the way, you now work for me.
Yes, that's true.
Right. I mean, that's a big one. Okay. It all sounds really happy until I just start understanding. And I've got independence now. I do my own thing. And now I'm going to work for this Greg guy. I mean,
well, you hit upon one of the things that's the most important aspect of M&A is that I think in M&A, people frequently spend too much time figuring out what the synergies are going to be and too much time looking at the numbers. At the end of the day, what's really important is that, yeah, those things you have to consider, but you really got to make sure that there is a cultural fit. And if you look at the M&A disasters, be they small or large companies that have occurred over the years, it's because there wasn't a cultural fit. In other words, we were looking not just for the things I mentioned, but we were also looking for business owners that were trustworthy, that had good teams of people, treated their people well, cared about how the future of their people, not just how much money they were going to make out of selling the business. And we found in those situations, there were always problems. When you go through the integration process, you date and everything's great, and you dream about how good the two businesses are going to be together. And then reality sets in when you acquire. And there are some, there's going to be some friction here and there. But the bottom line is, if you are on the same page, philosophically, culturally, with the people you're acquiring and with the people who are acquiring you, then you're likely going to work through the issues effectively. And we were, in all three cases we were. And when we ultimately sold to an insurance company, and Greg was reporting to, for the first time in 33 years, reporting to somebody rather than being my own boss, it worked because we philosophically and culturally, we shared the same values.
But when you're doing these acquisitions, though, the difficulty is that you're trying to convince me it would be better for me to again report to you and be part of something bigger.
Right.
Okay. So yeah, I can take some money off of the table. Plus, they probably did they have an interest in the new combined entity going forward?
No, none of my acquisitions had that, to be honest.
So you took them out. You bought their equity.
Yes, but they agreed to stay on for typically 3 years, and they did have some incentive. It wasn't an earnout per se, but they had some incentive to perform because we would give them a profit sharing in addition to a salary. So there was some incentive basis, but really we were dealing with people who would work hard and would do a good job, whether they had ownership or not. That's the kind of people you got to work with. And yeah, maybe they don't work quite as hard when they no longer own the whole thing, but the right kind of people will continue to work effectively.
So did they not walk away? How big was your company when you decided to do these acquisitions?
Okay, good question. So we were, I'm just trying to remember, we were about, I would say we were about 10 million in revenue.
Okay.
And we probably had, and back in those days, maybe 70 or 80 employees.
Okay.
So we were a decent sized company. The companies we acquired naturally were smaller.
How much smaller? That's what I'm trying to get to.
The first acquisition we acquired had about 12 employees. And they had roughly about 3 or 4 million in revenue. So they were, maybe 1/3 of our size, roughly.
Well, they sound like they were a lot more efficient than you were. If I got 12 employees doing 3-4 million, you got 10 million and you got 80 employees.
Yes.
They
Well,
sound like they
it
were
was a good
making.
acquisition.
What's that?
It was a great acquisition in that sense. They were efficient because they were handling accounts that were very much larger than the average account size of my people were handling.
Okay.
And so it was a different business, and it was a business that had a very high profit margin on it. So it was a great acquisition for us. We were able to get it at a very reasonable price. And so it was.
Why is that?
Well, it was a different day and time. It was in 2004. It was before private equity firms were chasing business in my sector the way they are today. They hadn't yet discovered our sector. And so we didn't have competition as much as we normally have. The other factor was, and this is kind of interesting, the owner had sold the business years ago to an insurance company. And then the insurance company had a change of ownership, decided we don't want this business anymore. They sold it back to him very, very cheap. So what I paid for the business was multiples of what he had paid to buy the business back a year and a half ago. and so yet it was a great deal for him. He was getting multiples in the sale of what he had paid to buy the business back. And I ultimately, if you look at what I sold my company for many years down the line, 8 years later, I got many multiples on his business of what I paid for it.
Right. And that's the hope of it all, right?
Yes.
I'm buying it for 3 times EBITDA and I'm going to sell it for 10 times EBITDA.
Exactly.
That's the whole idea, right? But, when you're a private company like that, there's no public comps. So here I am, you're trying to acquire me. I'm looking at public comps on what I'm worth. Okay. In other words, you're probably, if a private equity comes in, you're going to try to sell it for 5 times EBITDA. I want you to buy me like I'm a public company and I want 10 times EBITDA. You're like, I can't do that deal. There's no room for me to actually grow this value. Okay. If I overpay like that. So you're saying how much, like when you bought that company for $3 million in 2004, they had $3 million in revenue. What did you pay for that company?
I'm trying to remember, but it was probably 3 or 4 times their EBITDA, and so which was a very good deal. Looking back on it, and
was that $1.5 million acquisition or something?
I'm trying to remember. So it was about $4 million in revenue. They were pulling down almost a 50% profit margin, so $2 million in EBITDA. And I think we paid a multiple of 3 or 4 times that $5 or $6 million, somewhere around there. So we got it at a very good price, but it was multiples of what the guy had just paid to buy it back. So we just happened to be at the right place at the right
price, and they did well.
We were at the right place at the right time.
But so now here you are, a $10 million business, and you have to come up with $6 million to buy this guy's business. Yes. Where did the $6 million come from?
From most of it, well, some of it was we were very good about, we were a subchapter S company, and we would pay out dividends to pay our taxes, but the rest of it we reinvested in the company for the most part. We didn't pay ourselves big bonuses. And so we were building up the equity of our company just so we could do acquisitions. So we would be able to put up some of the money internally, but then the rest of it came from a bank. And really, from a bank point of view, we would sit down and run the numbers for them, and the numbers were good. I mean, from a bank perspective that understood our business, it was not a bad lending opportunity.
Were you hoping to pay back? So were you doing sort of a 1/3 your equity and then 2/3 sort of bank financing?
That's correct.
Okay. So then with the 2/3 bank fund, now I'm carrying $4 million in debt, and I was running a business with 0 debt, right? Until this acquisition. This $4 million, was that something that got paid out over time? Or was that something that you told the bank that it would be paid out at exit?
No, it was paid out upon acquisition. We paid the money up front, But the bottom
Well,
line
you
is
pay, you acquire it. I mean, the acquiree that. I mean, the
yes.
acquired company. But I'm talking about how did you pay the bank back?
We paid the bank back over time as we could. But bear in mind, we're in this the case of that acquisition, we're acquiring enough profit to service the debt, both in not just the interest, but enough to pay off some of that debt over time. So what we would do is we would do an acquisition on reasonably favorable terms. We would use the profit from that acquisition not only to service the debt, but also to start paying it down gradually until we make the next acquisition. So, we were very conservative the way we did it.
So was it a point in time that made all of this work? In other words, like you said, you weren't bidding against private equity at the time.
No, we weren't.
So these prices of these companies weren't being bid up to something unreasonable.
Yes.
So it's a strategy maybe that worked back then. And I like what you're saying. So what we did is we said, we got a bank behind us. We're buying cash flow based businesses that are very predictable, right? And so what we're going to do is pay a price that they pay back through their earnings of once acquired. They pay off the debt, okay, and they pay us back in effect, okay. And here I am now. I've got this business, and we're going forward. And now my business got bigger, so my multiple got bigger, right?
Yes. Yes, exactly.
Right. That makes a lot of sense. Can that work today?
It still can work, but it's harder. And here's how you make it work. So I mentioned to you earlier that I brought to the private equity fund an aggregator of insurance specialty businesses, and the private equity fund invested in that. Well, what this company was doing as an aggregator, they were doing what we were doing at Tomco, but they were acquiring much smaller companies. Because the problem is the radar has changed. So a lot of companies that I was acquiring in my day were too big. They're on the radar of the private equity firms and the private equity aggregators. So what this company did to get to a certain size was to acquire some very small insurance specialists, very, very small, and then help them build their infrastructure and grow. And then they were able to grow to the size where they outgrew their equity base, which was friends and family. The aggregator did. So they needed private equity to come in. But they had acquired these companies at pretty low multiples because they were very small companies, even below what the private equity today will do. And so when I came in with the private equity company and got them to, persuaded them to buy this company, now we've got private equity money. And now we can start doing larger acquisitions because we've got private equity money that can afford to pay much multiples more in line with the industry for those size companies. So now that's why within 1 year of acquiring this aggregator, we have over doubled the size of the company.
Wow. So, but it does, as the market becomes more sophisticated or as the multiples start to go up, you have got to have a war chest like a private equity firm behind you. You couldn't do your strategy that you did in 2004. It wouldn't work.
It wouldn't work.
Because that same guy that you bought for $6 million, now all of a sudden he's selling for $12 million, right?
Exactly. What you see right now is
that would mean you're taking on a tremendous amount of risk at that point, paying $12 million for the business, because did that business's earnings, would it been able to pay interest and debt, interest and principal at a $12 million acquisition?
No, exactly.
Would it
we could not have executed the strategy that my company used in today's market. We just couldn't do it. So what you see right now is that the companies in the insurance specialists that are making acquisitions, they're almost all have a private equity partner.
Is that the only way now for a smaller business? Like if you rolled Tomco back and you were still a young man doing this $10 million, okay, and you say, I want to do acquisitions, would you immediately have sold a piece of your company to private equity at that point
I'd
in
have
order
to.
you would have to?
I would have to execute that strategy.
I got it. Okay. Yeah.
Because
that's with the.
Here's an interesting thing. It used to be that in my industry that the companies that were paying the most were the insurance companies because they were trying to acquire business by buying up these insurance specialists. But now the private equity funds are paying more than the insurance companies are because typically they're willing to pay a multiple that the insurance companies aren't willing to pay because insurance companies don't trade for, as a general rule, for very high multiples in the stock market.
It would be dilutive for the insurance company, so that it's not, if it's not accretive, they can't make the acquisition. The board would never approve it.
Exactly.
Yeah. So what are these private equities? Since they're private equity, are buying these companies up at these now higher multiples? Where's their exit source? You see what I'm saying?
Oh, yes. Well, frequently,
their exit source isn't going to be an insurance company because now you're back to, I can't do an accretive deal with this private equity because he overpaid for all this stuff. So who's buying them?
Well, an obvious exit source, if you get really, really big, but you have to get really big, is IPO. But that's only for when you can get huge. If you can't get huge, which is more frequently the case, you're selling to another private equity firm. And what you do is you've got to grow. In other words, you can't just do it by acquisition. You've got to improve these businesses. So in the case of the aggregator that I just mentioned to you, that is backed by my private equity firm, not my private equity firm, but the one I'm affiliated with. In that particular case, we are improving these businesses. We're experiencing organic growth, and we're also improving the bottom line through expense control and better IT and et cetera, et cetera. So the businesses are being improved. And the margins are getting better on the same store sales, if you want to call it that. So if you're but to me, where the private equities are going to ultimately get in trouble, and is if they're just doing it purely by aggregation, and don't have an potential IPO exit. They're doing it purely by aggregation. The challenge is, and you're not improving the business, I think you're going to have a lot of trouble exiting with a profit, with an adequate profit.
Yeah, with an adequate return for your limited partners.
Exactly.
I mean, that's the issue with that. Huh. It seems to me with these private equity firms, that what was I going to say? I kind of lost my train of thought there. I had a thought about when you were acquiring these companies, the difficulty. Oh, I know what I want to ask you. I wanted to switch the subject a little bit. I wanted to talk about different boards. Okay. As when I look at having come from the startup, that's where I play, is the startup area. And I say there's, when you're trying to put together a startup board, it's really almost a hands-on board. All right. When you're there, you're not only talking about what the strategy is, but you're talking about how can you help make the strategy a winner. That's the kind of board.
Right.
Then a very other end, or the other extreme, is sort of the Coca-Cola board, which is a governance board, right?
Right.
So when you're dealing, where's your sweet spot? What would you say is the type of, what are the different types of boards that you've experienced?
Right.
And then what's your sweet spot? Where you enjoy, this certain type of board where this is something I enjoy going to.
I understand. Well, I am not on any startup boards, and I don't think startup is my best place to be. And on the other hand, I'm not on any publicly traded company boards. So I tend to, I'd say probably what you might call the middle market, although maybe it's still the small middle market of type of companies where the company's been around for a while, but they're trying to take it to the next level. like ARA, the example I gave earlier. I'm very good at best practices. So one of the things that I did in my business career, I belonged to a company. I was part of a group called Vistage. I don't know if you're
Right.
familiar with Vistage, but
I am familiar with
they're a
it. Yeah.
best practice organization for mid-sized companies. And
That's how you would characterize Vistage?
yes, oh yes, yes.
Oh, really? I just always thought that they were just a group of CEOs or business owners getting together to kind of learn or help each other.
Well, that's true. Nothing you said there is untrue, but it does a lot more than that, because you meet once a week with Vistage as a CEO with other CEOs. And I mean, not once a week, once a month, excuse me, once a month.
I was going to say,
that's pretty. My mistake. Once a month for an entire business day. Half of that day, you bring in a speaker that has been vetted by the organization, carefully vetted, that is a world-class mid-size company CEO speaker. It could be on marketing, it could be on finance, it could be on any number of HR, any number of topics. But this speaker comes in for 3 hours and basically teaches you best practices in that particular field. Then that's the morning. That's 3 hours in the morning.
That's a combined Vistage meeting. So you would have you were part of a group of how many CEOs in your Vistage group?
12. That's
12.
That's the typical size.
But when the speaker would come in, he wouldn't be speaking to just the 12 of you. There would be other Vistage groups, right?
No, just the 12 of us.
Just the 12 of you?
Yeah, the speaker would come in, and they were great speakers, and would speak to the 12 of us. So it was intimate. We could ask questions, etc. In the afternoon,
that's very personal. Yeah, I mean, that's
in the afternoon, we would act as an informal board of directors for each other. So out of the 12, 2 or 3 of us might present a major issue or challenge or opportunity in our business and ask for feedback from the other CEOs, which was great. I mean, it was great because you were hearing from people who had no financial interest in your company, no access to grind. They weren't employees. They just want to give you their best advice. And so it was very valuable. But I found that, both sections of the day were equally valuable. And so as a result of that, I did Vistage for 17 years. So after 17 years of Vistage, I love being on a board where I can talk best practices with the business. And it's hard to talk best practices in a startup, because in a startup, you're basically fighting for your life, as you know. And it's interesting and it's challenging, but you're fighting for your life to establish a foothold. And it's very hard to follow the discipline of best practices when you're just at the very beginning. That's why I like the mid-sized company.
When you talk about best practices, how would you define that, best practices? Is that you defining it as process? Okay, putting process in place, or how do you define it?
Well, for me to think of best practices, I think the best way for me to explain it is to get a little bit granular with one example. So, to me, a best practice is that is how you communicate with your people. The typical problem in smaller mid-sized companies is that the owner is so focused on building that business and being profitable, they forget that business isn't going to be successful unless the people who are working for you are totally on board with where you're headed.
Okay.
Communicating with them on a regular basis, group meetings, maybe a quarterly staff meeting where you bring everybody in and you actually share some data around what the company's doing and the goals and what you're achieving, what you're not achieving, et cetera, et cetera. Treating them like they're intelligent people who are even though many of them are not business owners, treating them almost like business owners. And that regular communication of what's going on at the company, because here's how it works in a company, in some of these smaller companies. The walls have ears, and there are problems, surface. And when a problem surfaces, if people don't have other information, they start making up their own story as to what's going on. And usually it's not flattering. Okay. So what's your job? One of your jobs as a business owner is to over communicate to your staff so they understand what you're trying to accomplish and what's going on and why certain initiatives are being taken, et cetera, et cetera. And so that people you are hearing your story and not just what's being talked about at the water cooler. So to me, that is a best practice.
Okay.
And then I could get, and I will not, a lot more granular on how you do that. So to me, it's those kinds of things that you've got to do in these companies to build a great company.
Do you ever feel that because of your age, your best practices are dated? So that you're dealing with somebody, let's say that's a 40-year-old Greg, who hears what you have to say and say, that might have worked then, Greg. It doesn't work now. Okay. You see what I'm saying?
I know what you're saying.
It depends how granular you get and how much, did the industry change? Do people change? Now we have disparate workforces, right? That they're all online. They're not present anymore. 30 people in the office out of 80, in any one week, Do you ever have them challenging you on that?
Yes, I do.
As a board member?
Yes, I do. And you get some of that. But and that is applicable in certain areas. For example, in IT, what I knew in IT from running my company 10 years ago, there's been a lot of change. And so what I know about IT isn't very transferable to today's marketplace. So I tread a little lightly on that when I'm giving advice. I do believe that certain best practices in IT, like doing due diligence around acquiring a new system, I think that is something that will not change. But the systems and how you use them has changed. So you got to be careful about that. But there are so many things that don't change. Like people are people. Now, one of the things that has changed is that we're in an environment where it's hard to hire people and to retain people. Well, in that environment, to me, it isn't that what I know and learned over the years is not applicable. It's only applicable that much more so, because you really got to work on retaining and hiring people effectively. And so you've got to develop your skill set even more now, 10 years later, than you needed to 10 years ago. And you need to learn new approaches to doing that. So, yeah, things change and you have to adjust to that. But I think that a lot of what I know as best practices will apply now and will apply 10 years from now.
It seems to me that if I was to think your superpower, where you sort of are, it was interesting where you went with your example, seems to be in leadership, or what I would call general management, how to be an effective general manager. You're not getting into the details on what's the best IT system, or, right. What's the best way, what's the best social media source to use for lead gen or anything. No, I work with the owner, CEO, if you will. Okay. And I help him become a better manager. That's what it sounds like. Is that what you do?
Oh, absolutely. I think that you hit the nail on the head of what leadership is all about. It isn't doing a lot of menial tasks and doing them well. It's about helping your people that report to you be the best that they can be and the most effective they can be. Let me give you an example of that. So, and it's an IT example. So I knew long before imaging and paperless systems were widespread, I knew that was the future. Okay, I don't know how I knew that, but I knew it intuitively, and not based on hard evidence. But especially in insurance, everything we do in insurance was paper, so it would revolutionize our industry. So I used to basically constantly preach to my management team, we have got to get paperless. Well, I asked a group of people to form sort of a committee, and they went out and they studied, what was out there. And they came back and they said, Greg, it's not there yet. The technology is not there yet because they haven't yet figured out, given the amount of the computing technology we have today, how to get these images small enough that they won't just, completely shut down a computer if you've got 1,000 policies on it. So I said, okay, but I kept hammering on it. And finally, one of our managers says, I think there's something out there that might get the job done. And we were one of the first companies to go 100% paperless on a new technology. It turned out to be a great technology. But I didn't do it. It was my COO who went out and implemented it, and who figured out where to find it, which brand, and how to implement it. So to me, that's what leadership is about. You know what direction you want to go. You have a vision, but you're unlikely to be the person to execute that vision. But you got to make sure you got a team that will follow that vision and is capable of executing on it.
When you're dealing with these operators as a board member, especially a new board member for them, what is it, or when, even as a non-board member, just talking to people in your industry that want to meet up with you, right, just to get a little advice, is there one piece of advice you're always going to give? It's always going to show up. It's, you're not anticipating it's going to show, but it does. It's always there.
Well, there's one piece of advice that I always give, but it's very insurance specific. So I don't know if you want me to share that. I would say the one piece of advice that I always give is that you can't, your people are your asset. In other words, your staff are your asset. Big mistake entrepreneurs and mid-sized business owners make. They get so caught up in building the business, they forget how important the people are. And if you treat your people well, I don't mean spoil them, you hold them accountable, but you do it in a way that makes them feel appreciated when they accomplish things. To me, recognition, study after study after study has shown that recognition, smart recognition of people, not just random recognition, really has a huge impact on performance and on people's willingness to stay in a job. And people thinks it's always about the money, and money's very important. Don't get me wrong, but that's understanding that people are your number one asset, and that communicating with them effectively, working with them effectively, treating them respectfully, but at the same time holding them accountable. That is something that is, to me, it's blocking and tackling. And if you don't get that right, you aren't going to get anything else right.
How about a couple of questions. One that brings to mind is that some operators, they say things like, oh, come on, I'm paying everybody. They're just a bunch of big babies. They need to just kind of put, they need to cinch their pants up and move with me. We need to just build this business. You must run into guys that it's one thing to say, we heard for a while, and this was back in the 90s, I still remember, is, people are everything. People are your asset. Yet, CEOs would say those things, but they didn't live it.
Yeah.
Right.
And you got to live
so
it.
how do you get somebody that doesn't have that sort of, they haven't embraced that philosophy yet, or the importance of it? How do you get them there? How do you can you move them, or there are just some people that you say, the guy shouldn't be leading this thing?
Well, there are some people that just can't get there. You're absolutely right.
Okay.
And I have for example, I have a friend of mine who's an entrepreneur that really struggled and never really succeeded in building a business. And he referred to his people as the kindergarten. He says
that's what I'm talking about.
It's like managing a kindergarten,
right.
They need to put
that was his management philosophy.
Exactly.
then you walk in and go, your people are everything. And he's like, yeah, right.
Yeah, exactly. Well, yeah. And I would say something to that effect. And he would respond by telling some war story about the latest stupid thing that one of his employees did. So you can't help it. But what I've discovered is that managers and leaders are different. You got to adapt your people philosophy to who you are. So, for example, I am a borderline introvert. Okay. And because I'm an introvert, I spent too much time in my office as an employer. So to get myself out of the office and among the people, one of the things that I devised was that is that we would pay quarterly bonuses, and I would go out and hand out those checks personally and talk with every single person in the office. Another thing that I devised was that we had an anniversary card for every employee. I would, if I didn't know them personally, something about them personally, I would talk to their supervisor. I'd write a long note about something they'd done in the business or some new thing that happened in their personal life that they were excited about. I would hand deliver that to them personally and say, I thank you for being part of this company for one more year. And, those are stupid little things, but I got to tell you, they're powerful. And especially for somebody like me.
Where did those come from? Where did the anniversary note come from? Where did the hand out the bonuses? Where did that come from you? When did you come up with that?
I came up with it because I realized, and it took me far too long to realize this, but I realized that, again, people are everything. My people were essential to my success.
What made you realize it? Because the guy that's running a kindergarten, he never realized it. Okay, so what made you realize it?
Well, I think, having some failures. I mean, having some employees that were unhappy, that left, that I didn't want to have leave. Having some people that I knew could perform better but weren't, and it couldn't seem to get them over the hill. Having a culture in my company where people referred to my company as a sweatshop. And just over time, I'm like, I got to do something different. Whatever I'm doing, it's not working. And so I started experimenting with things like this and started realizing that doing these goofy little things mean things to people. When the CEO...
Where were you? How old were you? Well, how old were you and how big was your company at the time?
I probably, when this dawned on me, we were probably about 20 people. And we were, maybe 1/5 of the size that we were when we sold. So we were a pretty small company, but I should have figured this out within.
But what you're telling me is you were trying to grow, and because of turnover or whatever else, you weren't growing. You got stuck.
People weren't happy being part of the company. Our turnover,
especially if you're calling your place a sweatshop. I love that. Okay. Yeah.
So I started thinking, how do I do this differently? And I didn't do it all at once. I mean, like the quarterly meetings where we would take a couple of hours and walk through the financials, maybe not full financials, but simplified financials and things like that, where I started treating people with respect. And we also got better. Another best practice was we changed our hiring practices. And I won't bore you with all the things we changed and the details of that, but there are best practices in hiring. And if you follow those best practices, you will get better people. And then those people will respond to the type of techniques I'm talking about very, very well. The better the people are, the more they're going to respond to better communication.
Greg, I think something to recognize here is it's not just putting in these little practices that we talked about, the handing out the bonuses personally, giving somebody a personal note for their anniversary or whatever it might be. There has to be a change in the leader.
Yeah.
You have to change.
Exactly.
You can't just be doing these little things and still be the sweatshop guy.
Yeah.
Okay.
Exactly.
Because you were the sweatshop guy. If you have your employees saying, this is like working in a sweatshop, it's because that's who you were as a leader.
Yes.
So how do you get to the point where you go, oh yeah, I need to start handing out these bonuses, but still I'm running a sweatshop? How did you change?
Well, I tell you,
remember back then what that was like?
Well,
because it's not working, and it's me. Yes. It's not them, it's me.
Well, there was one moment where that really happened. I mean, change happened over a period of time, but the big change happened in one moment, and that moment was I was embezzled, and I was not embezzled for a small amount of money. I was embezzled to the point of insolvency. My company was insolvent because my accounting manager stole hundreds of thousands of dollars. And so I woke up one day and discovered I'd been embezzled, that I had not been paying attention to what this guy was doing. I was too focused on growth, sales growth, and not focusing on the financials. Anyway, bottom line is I had to look in the mirror and say, how did this disaster happen? And I looked in the mirror and it was me. That I was doing something wrong. And I began at that point to question everything that I was doing.
What were you doing wrong? What did you say how did you get there? That's hard to say it was me as opposed to that SOB ripped me off, right? I treated him really well, He was one of my lead guys in the sweatshop. Okay. So when you said I looked in the mirror and it was me, what did you see at that moment?
I saw somebody who had not come to terms with with the fact that the problems with my company were primarily me. Even though this guy had stolen from me and I could easily have blamed him and said, oh, this terrible guy, and be a victim. I didn't want to be a victim. I wanted to be a successful businessman, and I didn't think being a victim would help. And so I looked in the mirror.
I'm sure your wife told you that.
Exactly. So
right. I know that Kathy would have told me that. She would have said, "Get it back out there and fix this."
Exactly. So I what was that comic strip where he says, "We have met the enemy, and they are us." And that was the moment of truth, and so I began questioning everything that I was doing, and it was about this time that I joined Vistage. And every week, every month, I would go to Vistage. I would learn something that I wasn't doing that I could be doing to make it a better company. And I was like all ears. I was like ready to hear the message. Because before that,
isn't it funny that when we finally hit bottom,
yes,
our ears open up, right? When we're at the top, we're not listening to anybody. Okay, so
exactly.
That's
and
cool.
The guys who get nothing out of Vistage are the guys who think they have all the answers. The guys in Vistage who really drew value from that organization, like me, were the guys who were humble and went in there and saying, I don't have the answers, and I know I'm doing some stuff wrong. Help me, help me figure out how I should be operating and what I can do differently. And from that moment on, I had a desire to change everything if necessary. And one of the things I learned in that process was I didn't really have a COO at that time. And I finally came to terms with that. I'm a great sales guy. I'm a great vision guy. I'm great at, like with the paperless thing, I was great at understanding that needed to be done. But I'm good with the staff, and good with our insurance company partners, terrible at day-to-day management of the people, terrible at day-to-day processes. And so I brought in a guy whose background actually was in manufacturing, although he had some insurance experience, to be my COO. And he revolutionized our company with the back room because I realized he had what I didn't have. And so I think another thing with being a good leader is not only knowing what you're good at, but accepting what you're crappy at and bringing in the team that can make up for your weaknesses.
Yeah, one of the things I wanted to ask is when you joined Vistage, okay, that's a big step for a lot of small business people.
Yeah.
Okay. And it's a big step because they think when you're a small business person, you are the smartest person in the room. You're it. I started this thing. I've got the idea. I have the vision.
Right.
But then you got cut off at the knees because of this embezzlement. Okay. That put you into, like you said, I was all ears. So you go to Vistage, and now you finally get to compare yourself to other operators. Okay. And they to you, everybody has something to contribute to somebody else.
Yes.
Everybody's experience, life experience and business experience is just a little different.
Yes.
Okay. What operators did you run into there that you immediately sort of attached to? What did they look like? What were those guys that you?
There was one guy.
You see what I'm saying? Because there's some people that talk and you go like, not that guy. This guy talks and you're taking notes. You follow me?
Well, fortunately,
what were those people like?
In our group, every in a Vistage group, you got people from all different industries. We aren't in the same industry. Right. So they all had different perspectives. I thought all of them at times had something worthwhile listening to. But one fella in particular had a huge influence on me, and he was actually managing director of a law firm, but he also had a business on the side, a small company that he was running. And he asked the best questions. What I learned from him was he could do more in a question than he could ever give in giving you advice. He could ask a question and you just blow you away and make you see something about yourself or about your business that you never could see. And so what I found were the guys who were the most effective in the Vistage group were the guys who asked the best questions, because those questions.
Were you able to learn that skill?
I was, and it's interesting because towards the end of my tour in Vistage, it got to the point where I was like that guy, where when I would ask a question, the room would get silent. And that question would be listened to, and I learned that skill from the people that were there before me. But yes, I did learn it, and it's so powerful.
What does it take to learn that? Because I've had people say that to me. You ask good questions. I want to learn how to ask good questions. How do you teach someone how to ask, how to get to good questions, real meaningful stuff?
Well, I suppose there are people who instinctively have that skill set, but if you don't instinctively have it, I don't think I had it. It's by exposure. Going to these meetings, these Vistage meetings, month after month after month, year after year, and you begin to see the mistakes that people repeat and make. And the other thing you learn is that a question is a lot less threatening than advice. So you say, this is what you should do, and you're doing this wrong, and you should blah, 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 blah. A CEO with an ego, and most of us have egos, pretty big ones, might get their back up. But you ask them a question, and there's sort of a heat-seeking missile in that question to get to the bit of advice and feedback you want to give this person. It's much more effective.
Yeah. It's funny, one of the best mentors I ever had in my life was that guy. I was reporting up to him. We sold our business to this bigger company, and this fella was responsible. He was about 10 years older than me at the time. He still is. He's still around. But his name is Jim Porter. And he was one of those guys that he would, in a business review meeting, he was a good operator. He would just ask questions. And the questions were, like you said, better than advice, because he led me to the point of thinking about the things that were most important to the business, right?
Exactly.
That maybe I was looking past, and of course, as operators, we want to solve problems, right? I just needed the right problem. What should I be working on,
Exactly. So, and those, and that's what you think about it. That's what a therapist does. A therapist frequently does not give a good therapist does not give a lot of advice. They ask a lot of questions. They get you talking about yourself, and frequently you get to the point of understanding what you need to do simply by good questions.
So being on one of the other things I wanted to ask you about, I wanted to go back to managing employees again. We talk about people need to be, you said, I have learned that people value recognition. Okay. That really, that motivates them to be recognized for their accomplishments. And that's true. But there's something else that's going on now. And this seems to be in this world with these, I don't know what they're called. Gen Z, I guess is what it is.
Yes.
Okay. At this point is they're looking for higher purpose. It's not enough just to have a job like we did and then buy into we're going to outperform the other dudes that are sort of with us, our peers, so that we get that next opportunity, and kind of move ahead that way. Now there seems to this, before they even get started, they want this sort of purpose. I talked to a CEO recently who said, yeah, what I saw is that I needed to understand their personal purpose and superpower, if you will. And that my job was to match it to our purpose as a organization that I'm running. Mm-hmm. And I sat there, I'm like, well, that's a whole nother level of management. Yes. Are you addressing that now? Or do you see this happening in these companies that you're on the board of, and that these operators have to deal with this now?
I haven't seen a lot of that,
okay.
because even the boards that I'm on, the company, while not huge, is big enough. They probably don't bring those types of things to me. They don't talk about it in the meetings.
It's too granular for your meetings, is what you're saying.
But one thing I did do in my company is we did have charitable organizations that we gave to, and I would match dollar for dollar. The employees would raise money, and I would match them dollar for dollar for anything that they raised for a charitable purpose. And I do think that you can do a lot of things like that to have people feel that they're aligned with a company that has some of the same values they have.
And where did you come up with that one?
Well, I just came up with it because some employees would talk about giving to a charity and raising some money, or having some type of potluck dinner every lunch everybody would pay for to raise money. And then I said, well, look, you guys are going to raise money. I'll match it, because I think that when anything you can do together in an organization as a group, you can do it together. It reinforces that you're a team, even if it doesn't impact the business directly.
Boy, you went through a massive transition. If you went from working for you was like working in a sweatshop yes. to what you're talking about now. So, and it's interesting that you're the greatest, or the single most frequent advice that you give to operators is you need to understand your people are your greatest asset.
Yes. And treat them that way.
Treat them. Don't just walk the talk. Don't just make the talk, right? Talk is cheap. Well, I know that we're going to end this here. Okay. I think this went in a different direction than I had expected it to go, which happens frequently. But I do think that this is going to be beneficial. The fact that we talked about it, how to do acquisitions and have an acquisition strategy as a small business, affiliating also now with private equity companies, which is certainly doable. And then this last piece of as your people being your greatest assets, I think is going to be super popular. So I appreciate you doing this with me, and I want to continue and have a few more conversations with you.
Well, that would be great, Charlie. I have thoroughly enjoyed this. Thank you.
Well, I think you got a lot to say. You've got a lot of great experience, and I do appreciate you sort of coming clean on some of the more difficult situations that you had. One being, I had a look in the mirror, and I have to say, we've seen the enemy, and the enemy is us, as you put it. That's I think that there's a humbling experience for any CEO or any business founder will only lead to making you a better leader.
Absolutely. I really believe that you learn more from adversity than you do from success.
Yeah, no doubt about it. Well, let me close. If you hang on just for a second. Ladies and gentlemen, thank you so much for joining me and Greg. We're going to continue our conversation, so there'll be more to follow. But I hope you enjoyed this, and we'll be back. Thank you.